The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or related financial instruments, nor should any of the content be taken as investment advice. Hi, this is Chris Ciovacco with Ciovacco Capital Management. With an ongoing battle taking place between inflationary and deflationary forces in both the economy and the financial markets, it may be more important than ever for both individual investors and professional money managers to have detailed contingency plans in place. During this brief video, we'll cover several possible market outcomes, as well as our possible response to those outcomes, for S&P 500 levels ranging between 940 on the low end and 1130 on the high end. Just like a coach who makes adjustments after a game begins, it's extremely important for our plans to remain flexible and adaptable based upon new information that comes to light. However, taking the time to run through these scenarios in advance should allow us to make more rational decisions in an environment where both market volatility and stress levels may again become elevated. During the video, we'll often reference the S&P 500 index. It should be noted that the S&P 500 can be used as a general proxy for all risk assets. As an example, if we mentioned that we would become more risk-averse relative to the S&P 500 index, that same general comment would probably also apply to all global stocks and commodities. If the S&P 500 can break above 1130, we'll examine both the technical and fundamental data that we have in hand at the time of the breakout. If we get a convincing breakout coupled with better than expected economic data, we may be willing to put some of our cash to work. However, if the breakout is less than convincing from a technical perspective and the economic data continues to disappoint, we'll take a more skeptical and cautious approach to any break above 1130. In either case, if the S&P 500 can remain above 1130, we would be more inclined to hold our current economically sensitive or cyclical assets like emerging market stocks, copper, oil, and silver. The next market scenario that we'll examine is if the S&P 500 trades between a range of 1040 on the low end and 1130 on the high end. Under these conditions, we'd be more inclined to have a balanced portfolio with some inflation-friendly assets as well as some deflation-friendly assets. Given the slowing pace of the current economic expansion and the deflationary forces that are present in the global economy, as long as the S&P 500 trades in a range between 1040 and 1130, we also want to hold some more conservative assets in our portfolios. Those assets might include cash, certificates of deposit, dividend payers, utilities, and consumer staple stocks. The next possible market scenario that we want to examine is if the S&P 500 breaks below the all-important 1010 level. Below 1010 on the S&P 500, the Federal Reserve and quantitative easing become significant wildcards relative to managing your assets. A break below 1010 on the S&P 500 may represent the most difficult scenario for both professional money managers and individual investors. It's possible that after a break of 1010, that talk of a deflationary depression will increase rapidly. It may cause some people to convert their portfolios to 100% cash. What makes it extremely difficult is the Fed at any time could announce a significant quantitative easing program. To complicate matters even further, it's possible that after a break of 1010 on the S&P 500 and after an announcement of quantitative easing by the Federal Reserve, the response by the markets in the longer term could be a collective yawn. There's no question in our mind that upon an announcement of QE2, or the second quantitative easing program, there'll be a sharp rally in risk assets, especially risk assets that are related to a weak dollar, like copper, silver, oil, and emerging market stocks. The real question becomes, how long will the rally last and how far could it take us? We'll just have to monitor things, especially volume, breadth, and technical indicators, and adjust accordingly. Should 1010 be breached on the S&P 500, some logical places for possible support from buyers come in at 978 and 940. A significant and fairly prolonged break of 940 may signal that a deflationary spiral has become stronger than the Fed's printing press. We would become very concerned and risk-averse should the S&P 500 close below 940 on a weekly basis. While there is no question that the odds of a double-dip recession have increased the further we've moved into 2010, an objective review of the data that we currently have in hand still says that the double-dip scenario is not the high-probability outcome scenario. However, our concern is that if the S&P 500 breaks 1010 and we see renewed weakness on the residential real estate front, this could fuel already strong deflationary forces in the economy. As we close out 2010 and head into 2011, we'll continue to monitor developments on the fundamental, technical, and political fronts. If we need to migrate rapidly to a deflationary or bear market portfolio, we will not hesitate to do so. However, if the financial markets can exceed extremely low expectations, we're willing to participate with a watchful and skeptical eye. If you've read the writings of Fed Chairman Ben Bernanke and more recently writings by James Bullard, including his 7 Faces of the Peril, you know the Federal Reserve is willing to use every tool and printing press in their arsenal in an attempt to reinflate asset prices and restore some semblance of the wealth effect. We understand that the Fed faces high hurdles in the form of mountains of global debt and fragile asset prices. With an almost infinite number of moving parts and polar opposite forces driving the financial markets, sometimes it's important to remind yourself of the following. No matter where the market is, it can only do 3 things from its current level. It can either move higher, move sideways, or go down. If we prepare for all of these scenarios and keep an open mind, we can reduce stress and have a better chance of successfully managing portfolios through this difficult period. Thank you for taking the time to watch the video. At Ciovacco Capital Management, we wish you nothing but success with your personal, professional, and market endeavors in the months ahead. Any opinions expressed in this video are subject to change without notice, and Ciovacco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decisions.